Hello viewers, welcome to this episode of NRI Money Clinic. I am Dr. Chandrakantha, but investment consultant and a practicing financial planner. Today we are going to discuss what you should do to generate a great returns on your investment portfolio. Many of the people are under the impression that you should do extraordinary things to generate good returns on investment portfolio. But you will be very surprised. You don't need to do anything extraordinary, not at all required. If you follow my simple ordinary steps which I am going to discuss now, then your investment portfolio should be doing very well.
NRI Money Clinic. No hype, just the right advice.
Let's look at what you should do. Point number 1. Do not do mistakes. If mistakes are inevitable, keep the mistakes under check. Keep them as little as possible. It's pretty ordinary to learn from your own mistakes. It's extraordinary to learn from others' mistakes. Please learn from people who have done mistakes in their life. I am that one person who have done mistakes in my early part of life. Today I know what works and what doesn't work. I am sharing these secrets with you. So let's look at what a mistakes can do to your portfolio. Let's imagine you have 100 units of investment currency. It could be dollars, GBP, rupees or whatever it is. And your aim is to generate 10% return. And you put this as a diversification into 10 different avenues of investment. Could be different shares, different mutual fund schemes, FDs, whatever it is. Now, if all of them do very well and you generate 10% profit, it's working very well. Now let's imagine if one of the investment, instead of generating a 10% profit, generated minus 10% profit. What happens in that case? Then if your whole portfolio, if still it has to generate 10% return on an aggregate, then the remaining 9 investment avenues where you have invested money should generate not 10% but 12% returns. Now look at if 3 of the avenues that you have chosen, instead of generating 10% profits, made minus 10% profit. Now the successfully running remaining 7 investment avenues should generate 18% return still to maintain your profit and the portfolio at 10% of the profit level. What happens if 50% of your portfolio generates minus 10% return? Now, the remaining 5 investment avenues which you have chosen should generate 30% return to compensate for this mistakes on the 5 non-working investment avenues for your portfolios to still generate 10% in aggregate. So, every mistake that happens in your portfolio is going to be an expensive affair. When I talk to people, they say, I invested in 10 shares, 4 didn't do, 6 did very well. So what happens in such a case is you feel very happy that 6 or 7 of the shares that you picked up did very well and the 4 didn't do very well. In reality, the ones which have lost money are going to offset the good things the remaining 6 investments have done. So rule number 1, don't do mistakes. If mistakes are inevitable, keep it under control, make it as less as possible. Rule number 2, you don't have to have great savings. You don't have to save a lot of money to generate a lot of profits. What is very important is 2 things, a disciplined saving and giving it a long time for it to grow. I will explain this with an explanation. Let's say if you are saving just a pretty ordinary 10,000 rupees per month and you save it for 30 years and your investment generates just about 10% profit, still you are the owner of over 2 crore rupees. If you hold it for 25 years, it's going to be about 1.5 crores. If you hold it for about 20 years, it's going to be 75 lakh rupees. So the key here is, it's not the how much of money that you put into your investment plan, but it is how much of time that you give it for it to grow. That's the most important thing. Many people do this mistake. They start investing in a very short span of time, they will remove this money. What happens is, it is like a crop which is being sown, and instead of taking this money, grow in a compounded fashion over a period of years, they just take out this money. Many are of the view that we need money. Yes, but you should identify that amount of money you need it for your long-term requirement. Let's say if you are a 25-year-old newly who have joined the job and you are doing this to fund your retirement, you still have 35 years of time with you. So once you identify it, then you can make best use of time in your favor. Point number 3, don't try to aim a particular rate of return. See, when I talk to people, they say that my expectation is 15%, my expectation is 20%, my expectation is 12%, my money should be safe. They keep telling me all kinds of things. A simple way to handle it is, you should aim at 2 hurdles to be crossed. Hurdle number 1, whatever is your prevailing bank rate of that particular currency, if it is dollars, if it is rupees, or any other currency, your investment portfolio should generate something more than the bank rate. This is hurdle number 1. If you are still generating less than the bank rate, then there is no need for you to create an investment portfolio. The purpose of creating an investment portfolio is to generate something over and above the bank rate. If you are not able to do that, then you can pretty as well go to a bank, deposit your money, and whatever they gave, you can take it. This is hurdle number 1. Hurdle number 2, which is more important, is try to beat the inflation. The purpose of any investment portfolio is to generate returns which beat inflation and create wealth. So when will the wealth be created? The wealth gets created when you are able to buy more goods and services from the money that you have invested than what it can buy today. Let me explain this with an example. Let's say that you have 1,000 rupees with you and you want to buy rice, and the present rate of rice is about 50 rupees a kilo. So this 1,000 rupees can buy about 20 kilos of rice today. Now you decide to invest this money in some investment avenue. Now in 1 year from now, if the underlying inflation is 5%, the prices will climb up by 5% from this year to the next year. Now the rice, the 20 kilos of rice which was costing 1,000 rupees this year will be costing you 1,050 rupees next year. If your investment portfolio generates 1,050 next year, that means 50 rupees over and above what you have invested on at a 5% rate of return, you are still able to buy just the 20 kilos of rice. It's not producing any wealth. Let's imagine you put this 1,000 rupees in the bank and the bank gave you 6% interest rate. Assuming that you don't pay any taxes, now your amount at your disposal is 1,060 rupees. So it's just more or less retaining the purchase value of this money. You are still able to buy just around 20 kilos of rice. Let's imagine your investment portfolio generated 11% return. In that case, the 1,000 rupees what you have invested this year goes on to become 1,100 rupees next year. Now the price of rice has gone up by 5%. Even then, instead of buying 20 kilos of rice, you will be able to buy roughly about 21 kilos of rice. That means the money which is valued at 20 kilos of rice today can buy you 21 kilos of rice next year. This is where wealth is going to get created. So the purpose is to aim something more than the bank rate of return, hurdle number 1, and hurdle number 2 is to generate something over and above the inflation so that the wealth effect gets created. Why do I say this? This is because the bank interest rates have to be always more than the inflation rate. It's generally 1 to 2% higher than the underlying inflation. But it need not be the rule. There are many times the bank interest rates are lower than the inflation rate. A classic example is between 2010 and 2014, when the underlying inflation, consumer price inflation was around 10-12%, whereas your bank rate was just about 9.5% rate of return. Viewers, key for a success investment portfolio is not putting a expected number on returns, but aiming to generate something over and above the bank rate of interest, and ideally to generate more than the inflation. Next point number 4. Do not invest in fashion, anything which is in fashion. It's quite common. See, if something is in fashion, it gets greatly advertised. It gets greatly discussed between people, friends, office. You go wherever people talk about this and you get attracted to it. One of the things that I have observed in my 25-30 years of career is if anything is in fashion, it will not generate you returns. So rule number 4 is do not invest anything which is in fashion. For example, in the year 2000 period where we went through a dot-com bust, dot-com companies, the IT companies were in great fashion. The price of these things went through the roof. Everybody invested in that. Many people, huge amounts of losses people created by investing in IT companies in 2000. In the year 2000, when the markets crashed, more than 50, 60, 70, 80, 100% of the money has been lost for many people by investing in these IT companies which were in great fashion. Come to 2007 and 8. The infrastructure companies, the real estate companies were in great demand. And you had people who invest in different mutual funds looking at the stars. All the people had given the rating agencies have given 5-star rating for these infrastructure companies. But they were in fashion, everybody was chasing and the price went through the roof, and when the corrections came, these funds decimated your portfolios. Even today, these portfolios have not got back to its original shape. Then what happened? The gold went through the roof. People got attracted to gold. People went overboard on gold and bought gold, and the gold prices crashed, and the same story repeats. Probably today what I see is your FMCG companies are having the same kind of a run. So the rule number 4 is do not invest anything which is in fashion. If it is something is in fashion, it's on the last leg of its journey on its upward move. The next leg is downwards. Point number 5. Do not overexpose yourself to any single asset class. Why do I say this? It's pretty common. Each individual has a preference for a particular investment. Some people are so fearful, they don't want to trust any other investment avenues, go and put money in the FDs. There are people who say only properties can work and they go overboard on properties. There are some people, nothing works for them except the gold, 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 gold. And there are so many people who says stock market is the only best investment avenue. My suggestion is do not overexpose yourself to any single asset class. Why do I say this? No single asset class works continuously. Each asset class has its time. Each asset class goes through a cycle. So a successful investment plan should invest in every asset class and not into one single asset class. Spread your investments into various asset classes. One or the other asset class will move through the fashion of the day and generate you returns, while others can give you a stability. If you get overexposed to one single thing, if something goes wrong, then your whole portfolio will be down the drain. 6th point. It's absolutely essential for you to compartmentalize your investment. What does it mean? It means money has a purpose. It's just not the quantity of money there. The amount of investment that you have made is for a purpose. For example, it could be just your emergency fund. It could be the money that you have set aside for your children's education purpose. It could be the money that you have kept to go on a world tour. It could be the purpose for building a retirement corpus. Each purpose is different and calls for a different approach while putting your money to work for you. Let's say in case of retirement, you have long time with you. So you can take slightly riskier assets and you can put small amounts of money, give it more time for it to grow, and it can work wonders for you. If it is your children's education fund, you can't take great amount of risk. Why? Because when your child becomes 17 years of age, he has to go to college. You can't come and tell an excuse that the share markets collapse, so my son, you please go to college 2 years later. You can't tell that. So you need an entirely different approach if you are looking from an education funding point of view. If the money that you have kept aside is for an emergency funding, it should be available to you on a call. So the approach we look for that is different. So it's very important that you compartmentalize your savings properly so that the expected returns or the expected results will follow. If you follow these 6 principles, you will have a pretty decent investment returns and you don't have to do anything great to generate this optimal results in your portfolio. So dear viewers, whatever the points I said, if it is of use to you, please don't forget to like my video, share it and subscribe for this channel. Don't forget to hit the bell icon so that whenever I release my next video, you will be notified. Look forward to interacting with you with one another subject in our one another video, which is coming to you very, very soon. Thank you very much for watching this episode.